We're here to talk about the first quarter of 2025. I'm here with John, our head of our investment office. So the first quarter was a volatile one. And why don't you talk us through, John, what happened in markets?
Well, it was a quarter of two halves, if you don't mind me saying it, where the first 6 weeks of the quarter were characterised by very strong, broad-based market gains. Second half was characterised by a sharp decline in markets led by the US.
Yeah, and it was really quite concentrated in parts in the US markets. I think on a relative basis, when we think about the performance of the portfolios, that was a help because we have a small underweight to US equities. So clearly that helped. But I think it'd be useful to go into a bit more colour on the US markets and maybe talk about what was the real drivers there.
Yeah, there were two main drivers. There was the DeepSeek AI development, which did call into question the dominance of the US tech titans because it seemed that China could develop at a fraction of the cost some quite powerful AI technology. And the other development was clearly an unhelpful narrative in terms of tariffs, which has caused a downgrade in terms of the domestic US growth outlook.
Yeah, and I think we can talk about tariffs in a bit more detail because I think obviously there's a lot going on. There's a lot of noise there. There's a lot of moving parts. But I think maybe if we just finish off on kind of the first quarter first, and we just touch on fixed income and we touch on the bond markets. We've been quite bullish on shorter dated government bonds for a little while. Maybe you could just talk a little bit about what's been the moving parts in the bond market over the quarter.
Yeah, so we've got a combination of deteriorating public finances, we've got slowing growth outlook, and we've also got sticky inflation. And those are really the three cross currents which are affecting bonds at the moment. Our view is that ultimately it's the downside risk to growth rather than the upside risk to inflation that will prompt central banks and the Bank of England to move. So for that reason alone, we're reasonably optimistic on short and intermediate dated gilts.
Yeah, and bonds or fixed income is the kind of ballast of the portfolio.
Yeah.
That's really what's provided the defensive element. And I guess it's kind of what helps us to sleep at night in these kind of volatile markets that we're seeing at the moment. And you kind of touched on tariffs. I've touched on the volatile markets that we're seeing. It would be remiss of us not to speak about markets at the moment. There's a lot going on. So maybe you could just give us a quick look through on what's happening at the moment and maybe a touch on the outlook as well.
Yeah, so we think that ultimately policy will be reflationary. That's to say that fiscal and monetary policy, where possible, will be supportive of growth and supportive of markets as well. But in the short term, we've got a downshift in terms of US earnings growth, and we've got a downshift in terms of growth as well within the US. And I think that's going to generate a little bit more underperformance of US equities against the rest of the world. But ultimately, policy will pivot in a reflationary way, and we think that will ultimately be supportive for the stock markets once we get through the summer.
Yeah, so I think if we think about the markets at the moment, there are risks out there, but I think we feel quite comfortable with understanding those risks. And I think when we do understand those risks, we can turn them into an opportunity for the portfolios. And so we're looking to continue to position portfolios to deal with that, and we feel comfortable with the outlook.